When you hear the word investing, you might think of the busy New York Stock Exchange or think that it is only for people who are richer, older, or further along in their careers than you. But this is the furthest thing from the truth. This video will talk about invest for wealth. Watch until the end, and if you want to see more videos from us, you can subscribe to our channel. Investing is a great way to make your money grow if you do it the right way. And almost anyone can invest in many kinds of things, no matter their age, income, or job. However, these things will affect which investments are best for you at this time. For example, someone who is close to retirement and has saved a lot of money will probably have a very different plan for investing than someone who is just starting out in their career and has no savings. Neither of these people should avoid investing. Instead, they should each choose the investments that work best for them. Here are the 6 best investments to think about, listed from least risky to most risky. Keep in mind that less risk usually means less money. Number 1. High yield savings accounts. Online savings accounts and cash management accounts offer higher rates of return than savings or checking accounts at a traditional bank. Cash management accounts are like a mix between a checking account and a savings account. They may have interest rates similar to savings accounts and may come with debit cards or checks. They are usually offered by brokerage firms. Best 4. Savings accounts are best for short-term savings or money you only need access to occasionally, like an emergency or vacation fund. You can only use your savings account 6 times per month. Cash management accounts give you more freedom and interest rates that are the same or even higher in some cases. If you are new to saving and investing, a good rule of thumb is to keep 3 to 6 months worth of living expenses in an account like this before putting more money into the investments further down this list. Number 2. Certificates of deposit. A certificate of deposit, or CD, is a savings account that is backed by the federal government and has a fixed interest rate for a set amount of time. Best 4. A CD is a way to save money that you will need at a certain time in the future, e.g., a home down payment or a wedding. Most CDs have terms of 1, 3, or 5 years, so they could be a good choice if you want to grow your money safely for a specific purpose in a set amount of time. But you should know that if you want to get your money out of a CD early, you will probably have to pay a fee. As with other types of investments, you should not buy a CD with money you might need soon. Number 3. Money market funds. Money market mutual funds are an investment, not to be confused with money market accounts, which are bank deposit accounts similar to savings accounts. When you put money into a money market fund, that money is used to buy a group of high-quality, short-term debt from the government, a bank, or a company. You are willing to take a little more market risk with money you might need soon. Money market funds are also used by investors to keep a part of their portfolio in something safer than stocks or as a place to put money that will be used for future investments. Even though money market funds are technically investments, they do not have the higher returns or higher risk of the other investments on this page. The growth of money market funds is more like the growth of high-yield savings accounts. Number 4. Government bonds. A government bond is a loan you give to a government entity, like the federal or local government. The government entity, like the federal or local government, pays investors interest on the loan over a set amount of time, usually between 1 and 30 years. Bonds are called fixed income securities because they pay out money in a steady stream. Government bonds are almost risk-free investments because they are backed by the U.S. government's full faith and credit. What are the cons? Government bonds are safe, but you will not get as much money back from them as you would from other investments. If you only had bonds in your portfolio, instead of a mix of stocks and bonds, it would be much harder to save for retirement or other long-term goals. See our bond explanation for more. Conservative investors who would like their portfolios to be less volatile. Bonds add stability to a portfolio because they tend to go up when stocks go down, says Delia Fernandez, a certified financial planner and founder of Fernandez Financial Advisory in Los Alamitos, California. This makes it easier for nervous investors to stick to their investment plan and not sell out of fear. Bonds are popular with investors who are nearing or already in retirement because they provide a steady income and are less volatile than stocks. This is because these people may not have enough time to wait out sudden or severe market drops. Number 5. Corporate bonds. Corporate bonds work just like government bonds, except that you are lending money to a company instead of the government. Because of this, the government does not back these loans, which makes them a riskier choice. And a high-yield bond, which is sometimes called a junk bond, can be a lot riskier, with a risk/return profile that is more like stocks than bonds. Investors who want a fixed income investment that could pay out more than government bonds and are willing to take on a little more risk. When it comes to corporate bonds, the yield goes up the more likely it is that the company will go out of business. On the other hand, bonds from large, stable companies tend to have a lower yield. It is up to the investor to find the right mix of risk and return. Number 6. Mutual funds. A mutual fund is a group of investors who pool their money to buy stocks, bonds, or other assets. Mutual funds give investors a cheap way to spread their money across multiple investments to protect themselves from the loss of any one investment. Mutual funds are a convenient way to invest in the stock market without having to buy and manage a portfolio of individual stocks. This is good if you are saving for retirement or another long-term goal. Some funds only invest in companies that meet certain requirements, like technology companies in the biotech industry or companies that pay high dividends. That lets you focus on certain types of investments. To buy mutual funds, go to. Mutual funds can be bought from both the companies that run them and discount brokerage firms. Almost all of the mutual fund companies we look at offer no transaction fee funds, which do not charge commissions, and tools to help you choose funds. Be aware that mutual funds usually require a minimum initial investment of anywhere from $500 to thousands of dollars. However, some providers will waive the minimum if you agree to set up automatic monthly investments. So, that is all for today. We are glad you watched. If you appreciated this video, like it and share it. Do not forget to subscribe to our channel and click the bell icon to get notifications of new videos.